Hello friends, today we will move on to the final leg of comprehensive financial planning, that is tax planning. Through this series, we will introduce you to various important concepts relating to income tax, taxation of various asset classes, and deduction and exemptions available under the Income Tax Act. Let's start with income tax basic concepts. First of all, assessee. Assessee is a person by whom income tax or any other sum of money is payable under Income Tax Act. It includes every person in respect of whom any proceeding has been taken for assessment of income or loss or amount refund due to him. It also includes person who is assessable in respect of income or loss of another person or deemed to be assessee or assessee in default. So who are the person under Income Tax Act? It includes individual, Hindu undivided family, company, firm, association of person or body of individual, local authority, and artificial judicial person. What are the heads of income under which income is assessed? There are primarily 5 heads: salary, income from house property, profits and gains of business or profession, capital gain, and other sources. Now let's discuss concept of assessment year. Assessment year means period starting from 1st April and ending on 31st March of the next year. Income of previous year is taxed during following assessment year at the rate prescribed. So what is previous year? Year in which income is earned is known as previous year. Exception to the rule, income of previous year is taxable as income of immediately following assessment year are income of non-resident from shipping, income of person leaving India either permanently or for long period of time, income of bodies formed for short duration, or income from discontinued business. In all these cases, income of previous year is taxed in previous year itself. Let's now discuss the concept of residential status. A person can be ordinary resident but not ordinary resident, or non-resident based on fulfillment or non-fulfillment of following condition. An individual who fulfills any one of the following 2 tests is called resident. If he is in India during the relevant previous year for a period amounting in all to 182 days or more, if he was in India for a period or periods amounting in all to 365 days or more during 4 years preceding the relevant previous year, and he was in India for a period or periods amounting in all to 60 days or more in the relevant previous year. After fulfilling one of the above 2 tests, an individual becomes resident of India. But to become an ordinary resident of India, an individual has to fulfill both of the following additional conditions. He has been resident of India in at least 2 previous years out of 10 previous years immediately prior to previous year in question, and he has stayed in India for at least 730 days in 7 previous years immediately preceding the previous year in question. After determining the residential status, we can say that following incomes will be taxable or non-taxable for different residential status. Income received or deemed to be received or accrued or deemed to be accrued in India is taxable for all types of assessee. Income arising outside India from a business profession situated outside India but control management of it is in India is taxable for all types of residents. Income arising outside India but management and control is also outside India is taxable only for ordinary resident. All types of other types of foreign income will be taxable only for ordinary resident. There are different rate of tax for individual, resident senior citizen, and resident super senior citizen. Additionally, a surcharge of 10% of tax where total income exceeds 50 lakh and 15% of tax where income exceeds rupees 1 crore. An education cess of 3% of tax plus surcharge. Note: a resident individual is entitled for rebate under section 87A if his total income does not exceed 3.5 lakh. The amount of rebate shall be 100% of income tax or 2500 whichever is less. As per section 10(1), agriculture income is exempt from tax. Agricultural income means any rent or revenue derived from land, any income derived from such land by agriculture, any income derived from building on or in immediate vicinity of land. For individual, a scheme of partial merger of agriculture income is there. If non-agriculture income exceed basic exempt limit, net agriculture income exceed 5,000. Following steps should be followed to calculate tax. Add agriculture income and non-agriculture income and calculate tax. Add agriculture income and basic exempt limit and calculate tax. Deduct tax computed in step B from tax computed in step A. Add cess at 3% on amount computed. Amount so arrived is tax payable. For example, agriculture income is 3 lakh and non-agricultural income is 5 lakh. So total tax payable after cess will be 51,500. Let's now move on to clubbing of income. Usually you are only taxed for your income, but under certain special circumstances some incomes are clubbed along with your income and you may be liable to pay tax on such clubbed income. The intention here is to make sure there is no tax that escapes in case an individual is moving assets or income in the family. Here we have presented nature of transaction clubbed in the hands of and any conditions or exceptions. Following are the cases: transfer of income without transfer of assets, revocable transfer of asset, salary, commission, fees or remuneration paid to spouse from a concern in which an individual has substantial interest, income from assets transferred directly or indirectly to spouse without adequate consideration. Moving on, income from assets transferred to son's wife, transfer of assets by an individual to a person or AOP for the immediate or deferred benefit of his son or son's wife. Income of minor child includes stepchild, adopted child and minor married daughter. Income of HUF from property converted by individual into HUF property. As we know, there are 5 heads of income. Sometimes it happens that one head has profit and other head has loss. So income tax has a provision of set off and carry forward of losses. Let's first discuss set off of losses. Set off means adjusting the losses against profit of that financial year. First of all, there is intra-head set off. If the taxpayer has incurred some loss, then taxpayer is allowed to adjust it from any other source of income under the same head. Following are the exceptions: speculative business losses, long-term capital losses, income losses from owning and maintaining racehorses, income losses of specified businesses. Next we have inter-head set-off. If taxpayer has incurred loss under one head of income and is having income under any other head of income, then taxpayer can adjust the loss from one from other. House property income losses, it can be set off against profit from any other head. Non-speculative business losses, it can be set off under any other head except salary, that is income from house property, income from capital gain, income from other sources. In following cases, losses cannot be set off under inter-head adjustment: speculative business losses, specified business losses, capital gain losses, losses from owning and maintaining racehorses. If there is no adequate profits to set off entire loss, it can be carried forward to next assessment years subject to the conditions stated in the Act. Following is a summary of carry forward of loss. Loss from house property can be carried forward for 8 years and can be set off against income from house property or salary. Unabsorbed business loss for 8 years from profit and gains of business or profession. Speculative business loss for 4 years from income of speculative business. Short-term capital loss for 8 years from short-term or long-term capital gain. Long-term capital loss for 8 years from long-term capital gain. Loss from activity of owning and maintaining race horses for 4 years from income from same activity. Carry forward of losses is allowed only when such loss have been declared by filing ITR within due date, except house property loss, which can be carried forward even if return is not filed on time. For any income which is exempt, like LTCG on listed equity share, its loss is also not allowed to be set off or carried forward. Thank you.